Howdy there, folks. Welcome into today's video. Three up for me to react to. It's a three-piece here today. Spirit Airlines was down massively. The stock finished down 47%. It was down about 60% at the lows here today. So we're going to speak about Spirit Airlines. Want to react to this video here, and then just look at the stock quickly here and kind of tell you my opinion on if I think this is a buy the dip opportunity on a massive crash here today, or it's a kind of a stay away from situation. Okay. Then from there, we'll react to this one. Courtney Garcia saying investors, which I'm wondering, did she ever have her baby? I remember she was pregnant last year. Investors aren't putting their money where their mouth is. That should be an interesting one. And then the last one up here is they call him the Dean of Valuation. He feels like the market is overvalued right now. So we'll hear what his perspectives are. I want to share my perspective on if I think the market's overvalued right now or not. So appreciate y'all joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. And let's go ahead and get into the Spirit Airlines one first.
The JetBlue Spirit merger case, and it is against JetBlue and Spirit merging. The DOJ victorious judge has decided this merger will not go through. Take a look at shares of JetBlue and Spirit, and that's why you see the reaction that you're seeing, especially with Spirit down, 47%. A judge, again, deciding that the DOJ has prevailed in proving that it would hurt competition if JetBlue and Spirit were to merge. So as a result, you will not see this merger between JetBlue and Spirit. Again, DOJ victorious in this case. Tyler, I'll send it back to you.
Is there any route of appeal for Spirit and or JetBlue here?
I would assume that there is, but I don't know for sure, Tyler. And then the question also becomes, if you are JetBlue and Spirit, do you want to try to pursue an appeal? This has been a long process, and even though people said from the beginning, look, with this, DOJ, that they were going to go against it, but they, remember, they had to outbid Frontier, JetBlue did, in order to get this Spirit deal announced. And Spirit agreed to it. So now the question becomes, do you want to go through that process if an appeal is possible?
I wonder if there is any partner for Spirit that would not arouse the ire of the DOJ.
Great question. In this environment, I have to wonder that too, Tyler. Look, the people at Frontier long believed that a combination between Frontier and Spirit would make sense. Because there was not as much overlap as there would be with JetBlue and Spirit. But at the end of the day, even with JetBlue saying, look, we will divest gates, we will pull back some of the exposure that would have been there, especially in Florida and parts of the tri-state area, that wasn't enough. The judge said, at the end of the day, this is going to hurt competition. I'm paraphrasing here. And as a result, the merger is not going through.
Now, before we get into if Spirit is a buy on this, there's something important to understand. From my understanding, JetBlue has to pay a huge sum of money to Spirit now. From my understanding in regards to this matter, Spirit is going to get $70 million from JetBlue because this deal essentially didn't go through, which is, not a small amount of money. So $70 million is $70 million, right, for just the deal not going through, essentially. Now, in regards to Spirit, right, I think everybody knows Spirit Airlines from the memes, at least. If you've never flown on them, you at least know from all the memes all over time, right? But, this is a company, so there's some troubles. One, it's an airlines. I don't really like airlines, for one. It's just an industry I'm not a huge fan of. Very, very capital intensive. Things happen all the time that are out of the airline's controls, such as bad weather can screw things up in a massive, massive way. Obviously, demand can shake around quite considerably. These airline companies could go from making huge profits to huge losses, and it can happen in a pretty quick amount of time. So if we look at kind of earnings estimates with this company, one is it's still expected to be a money loser. So, and not just a small money loser, like this is significant, like $3 plus a share over the next couple of years, right? And then look at the revenue growth expected, very, very low for Spirit, okay? So the question is Spirit a buy? The answer is absolutely not. It's not a good ownable asset for the long term at all, just to be quite frank. With that being said, there was probably a swing trade to be made. That 60% down move, that was too much. And, if you could have scooped some shares up in the 5s this morning and then went ahead and dumped out in the 7s and 8s this afternoon, great. Great for you. But outside of that, for like a long-term investment, this just doesn't look very promising. It's an extremely competitive industry. Profits are tough to come by. And this company's been losing money, and that's with the environment for these airlines to actually be pretty dang good. It's been a good environment. We've been in revenge travel for 2 years, right? That might actually be coming to an end here in 2024. And so if revenge travel starts to actually slow, you could see the losses for a company like Spirit uptick quite considerably. So I just look at this one and I'm like, we can look at the balance sheet here. If we look at the last report, $818 million in cash, so $929 million in cash and investments. So that's good news. $1.4 billion in current assets right there. Total assets of about $9.3 billion. Okay, good. Problem is total current liabilities 1.6. So total current liabilities is actually above where total current assets are at. That's no bueno. That's no bueno. Occurred expenses, $638 million right there. Current portion of long-term debt's $235 million right there. That's no bueno. Long-term debt's $3 billion. So we're talking about a 3x the cash and investments just in long-term debt here. So overall, Spirit could end up as a bankruptcy candidate. It could. It's no guarantee this one goes into bankruptcy, but it could end up as a bankruptcy candidate. With that debt load, with kind of where their cash is, yeah, sure, they're going to get $70 million, but they got $3 billion plus in debt there. And if they keep losing money like this could end up being a company that, a year from now or 2 years from now is a bankruptcy candidate. Is it a stock I'm looking to buy, short? Probably not. Is it a stock I'd potentially consider to buy some put options on? And the answer to that is maybe. But a lot of that comes down to how expensive are the options, right? If the options are super expensive, let's say we're going to hedge and we're going to say, hey, it could be a hedge on a bankruptcy at some point in 2025. Well, if we look at puts here, let's say $7.50. I mean, gosh, you got to pay $2.25 for that? Are you kidding me? Even at the $5, you got to pay $2. So you need the stock to go down to $3 just to break even. So you still need another 50% plus downside from here just to break even. So would I even be looking at puts? Probably not, because it's not attractive enough. Because I'm not the only one that recognizes that Spirit could be going bankrupt in the next year or two. So, yeah, no, and nope. Next one up here, Courtney Garcia. Investors aren't putting their money where their mouth is, and then we'll get into the Dean of Valuation and what he says about this market, and you'll hear my perspective on if I think the market's overvalued or not.
Quite a bit of pressure this morning. With that in mind, how do you see today shaping up? What's your WEX word of the day?
Yeah, actually, this perfectly describes my word of the day, which is skepticism. I'm sure you've heard before that the markets are born on pessimism. They grow on skepticism. They're going to mature on optimism and die on euphoria. We're clearly going into that skepticism phase where we were definitely pessimistic last year. When you're seeing with investors, they're showing that they're investor sentiment optimism.
To be fair, it depends on who you're talking to, because there was a lot of people that were definitely pessimistic last year, but there was also a lot of people that were skeptics of the market last year. So it really depends on who you speak to in regards to that, right?
Actually high, but they're not putting their money where their mouth is. There's still a lot of cash on the sidelines, and cash levels actually went up last week, showing that investors are not yet ready to put their money in. As you're seeing right now, is markets are having a hard time really starting the year off this year after such a strong end to last year. But I think that's all the more reason that we have this cash on the sidelines. As if
who said that was going to happen? Who said that was going to happen?
Does in fact come down, you're going to see that come off and go back into the markets. And I think it's all the more reason the markets will eventually go higher this year. Okay. It's just having a little bit of a false start here.
All right, so you see the markets going higher long term, but important to note, the S&P kind of peaked into positive territory last week. Now it looks like it'll open up negative for the year when the opening bell comes, if the trend in futures continues. What does that signal to you? And really, what happened to this broadening of the market that so many people were talking about?
Yeah, you're definitely seeing this consolidate here, which I don't think is that abnormal. We had a really fantastic run from the end of October through the end of the year, and you're now starting to see that pull back a bit here. And especially now you're seeing earnings are starting, and that's going to be the focus this year, where there's a lot of optimism, especially with artificial intelligence. And now you're going to want to see that actually reflected into earnings or reflecting into profits. And so you're going to see investors, I think, are taking a little bit of a sidelines until we actually see how earnings are shaping up. We're already seeing that starting here, and I think you're going to start to see some more reflection of that as we go forward. You just need to see some more numbers coming out here.
Courtney, you're saying investors are a little bit on the side.
I don't know if they're really, it depends on the stock. It depends on the stock big time here. I don't think they're really doing it with a lot of stocks. Like I want to take a peek at some of the big dogs and see how those ones are doing year to date, because I think there's several big dogs that are already off to a good start this year. Well, maybe there's other stocks, really struggling. There's other guys doing very well. So Shopify so far already up 10%. Jeez. Nvidia's already up no way. Already up 17% this year. Netflix 2.7%, AMD 14%. See Meta's already at a 6% gain for the year. Let's see a Snowflake's about break even roughly. Oracle 2.4%. Microsoft 5%. So it really depends on the stock. Apple's having a little troubles here. Amazon 2%. It really depends on the stock, but most of these big dog companies are already off to a great start. Where we're seeing a lot of the weaknesses in the Russell, in some of the smaller cap companies, mid cap companies, some of the less trusted companies. But the trusted companies, they're off to a great start this year.
According to the latest data from the...
Which, by the way, is exactly actually how last year started. That's exactly how last year started.
Company. It's about $6 trillion on the sidelines, so it's more than just a little bit. With that in mind, as you see that money come off the sidelines, I'm sure some of your clients are in that group. Where would you allocate money to? Are there certain sectors that you would put money to? Are there others you would stay away from?
Yeah, we're making sure that we have broadly diversified portfolios, but we are actively taking profits from those large, the Magnificent Seven companies that did really well last year. And we're adding to things like small caps, things like energy, things like real estate, some of those interest rate sensitive sectors. We're making sure we're taking profits and adding there. But also we are seeing a lot of people with cash on the sidelines. That's not what we're recommending right now, because we do anticipate interest rates to come down this year. And the first thing that's going to reflect downward are your money market funds. So you do not want to be sitting those forever. You're going to have that interest rate risk where you're going to eventually be reinvesting those into lower rates. So on the safety side of your portfolio, you do want to start to look to extend some of your duration on your bonds, just to make sure that you're locking into some of those rates that are available right now. Sitting too much in cash is really not.
To push back against her a little bit here in regards to the rates coming down, right? Usually the Fed starts lowering rates when things start getting bad, right? So you could be in a situation where the market deteriorates for a bit of time after that, whether it be 6 months or 12 months. Now, that's no guarantee, but it's just a potential. So I think it's still prudent to have some cash around. I really do this year. I certainly don't want to be 100% invested in the market, nor do I ever almost want to be 100% invested in the market. But I'm going to continue to invest on a weekly basis. But do I want to be 100% invested? Absolutely not. I want to continue to have some cash on the sideline. You can get great returns on cash. You can still get like 5% for at least probably the next 6 months, if not 12 months, in terms of a 4 to 5% range on your cash if you have it in the right savings account or treasuries.
Long-term strategy, and we're actively talking to all of our clients about that right now.
So, interesting thoughts from her there. Let's go ahead and get into the dean of valuation, and if he thinks this market's overvalued, and then I'll explain why I think the market's overvalued or undervalued right now.
Simple question. Is it a simple answer?
I think right now the market is overvalued. I mean, my estimate is about 9-10%. And part of the reason, I think, is the expectations game has turned against the market. I mean, if you remember at the start of last year, recession was almost guaranteed, rates were going to go up, inflation was out of control. And every strategist that you had essentially said was going to be a terrible year for stocks. Turned out to be the exact opposite. Everything turned out to work in the opposite direction. My fear is that we've moved too much in the other direction. Now people assume there's no recession. Inflation is under control.
To push back against him right there, not everybody said 2023 was going to be a bad year. What I think the consensus was, based upon what I heard, and, having this reaction channel, listen to all these Wall Streeters all the time, what the consensus was going into last year, into 2023, was we were going to have a really bad first half of the year, and then the second half of the year was going to be better. That was the overall consensus. I can tell you what I felt out there and what I heard out there. Obviously, the first half of the year was booming, caught a lot of people off guard, right? And then a lot of those people that wanted to buy in the back half of the year because they thought it was going to be a good year, they kind of got forced into the market. And I think that's what actually happened in the market. And those fund managers and a lot of those folks started to underperform the indexes quite considerably, and they had to play catch up into year end, which is exactly what I said would happen, and that's exactly what happened. That's why October, if you look at mid-October through about the end of December, I mean, it was just boom times for the market. Everything was flying because let's just call it what it is. People were caught off guard and they had to play catch up. It could happen again this year, by the way. It could. We know there's a lot of people that are kind of, still very skeptical in this market. We already see some of these big dog companies running really quickly here, the NVIDIAs and the AMDs and the Metas and some of these stocks. So we'll see how this shakes out, but you never know. It could be a replay of last year. I'm not expecting that. I'm expecting still some big sell-offs in a lot of even those stocks. Obviously, we're already seeing some sell-off in the Russell, considerably already this year, and some of the small caps. But I think we still will get a pullback this quarter in a lot of these big dog stocks. That's coming here in a bit. You just got to be patient on that.
Well, and everything's going to be okay. So I think this year, good news is going to require a lot more than it did last year, and that to me is why I think stocks are in a dangerous place right now.
Well, what if, in fact, inflation is coming down at a pretty good clip? And what if the economy is holding up pretty well? Then that would obviously throw the equation into a different answer.
That's already priced in, and I think that's the problem is we're pricing in the good stuff. And I think the worry now is there might be surprises. In fact, there will be surprises. You go back to 2008, every single year, we've had some big surprise that nobody saw coming. And I'm sure there will be it's an election year. I can't see this year going by without significant big surprises. So to me, that's the danger you face investing in stocks right now.
What about the prior guest?
And that's why I said I think this could be a much more volatile year than 23. 23 was pretty chill. Other than SVB happened there, and that got volatility up for just a bit, and then it died right down. I think this year could definitely be more volatile. We got a lot more things at play this year. And so I think you're going to see some much bigger quick moves to upside and downside in this market. And so it's going to shake some people around. It's going to shake some people out of the market this year. The real players will stay around. They'll buy those dips and they'll take advantage of those deals because you could get 10 to 20% corrections very quickly, 5% corrections very quickly. They'll shake some people out. And ultimately, those will be huge buy the dip opportunities that will present themselves.
Just spoke with who suggested, certainly one of them, that staples, REITs, utilities, all these unloved places of a year ago are cheap on a valuation standpoint. How do you view those?
Well, part of the reason they're cheap is they didn't have a recovery last year. If you look at what stocks did last year, even though overall stocks were up 26%, lots of sectors actually had single-digit, and utilities and real estate and energy were actually down last year. And if you take utilities, which had a bad year the previous year as well, it's been 2 bad years in a row. So in a sense, they're better priced. And as a defensive investment, I think they're okay. But they're not going to make you 20% returns this year. That's not going to happen.
Maybe some people would be like, you know what, that's just fine. I mean, I don't necessarily look for 20% return. I just want some, a relatively good return. Is there an area of the market, Professor, you look at and say is particularly attractive because it is cheap enough?
I think utilities would be the place I go for that reason. I think that energy is always up and down. Energy had a great year the previous year. It gave back some of those winnings. I mean, utilities have been surprisingly down over the last 2 years because, last year you can't blame interest rates. The T1 rate actually ended the year at exactly the same level that it started the year. So from an interest rate perspective, it should have been a good year, but it did not have it. So maybe it's overdue. And that's, I think, one reason I would look at utilities going forward.
All right.
Yeah, utilities, if you're really bearish on the market, utilities are a good play. It's usually a relatively good preservation of capital, let's just call it that. Do I feel the stock market's overvalued or not? And the answer to that is I don't feel the stock market's overvalued. I also don't feel like we're in an undervalued market right now. I feel like we're pretty fairly valued. I think if you look at mega cap, I think we're on the upper ranges of valuation. I think if you look at small cap, we're on the lower valuation ranges. But that's nothing new. We've actually been here for a bit now at this point in time. At some point, that's not going to stay like that. I can tell you that. At some point, smalls are going to really come back. And I say really come back, I'm talking about for real. And I don't know about the 50% upside like the Tom Lee's expecting, but I'm talking about like the Russell rolls like a 25 to 30% gain in like a 12-month span. I'm talking about that sort of real comeback in small cap stocks. So that's just kind of a waiting game in terms of that, and that will eventually play out that way. So that's where I'm at valuation wise on this market. You can look at Yardini Research. He's always got a lot of great numbers and metrics to look at, kind of broken down by sectors, broken down by different stocks and things like that. Okay. Appreciate y'all joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. Much love as always. If you're looking to apply, join my private group, get access to all my courses, access to the 6 to 7-figure Discord chat, access to see the moves I'm making in my nearly $2 million Fidelity account. Check out the pinned comment down there. You fill out an application. We could probably get you in there maybe later this week or something like that. Much love and have a great day.